So the stock that I'm talking about is Barratt Redrow. It is the UK's largest house builder with about 6 billion sterling in revenue in the last 12 months. It operates under three brands. The original Barratt brand, founded in 1958, was oriented towards first-time buyers. You can see a photograph of a typical Barratt house in the top right picture there. David Wilson, which it acquired in 2007, is more of a kind of mid-market brand, photo in the middle. And then Redrow, acquired last year, a bit more of a upmarket, slightly premium price brand. It has 6.4 billion pounds in tangible net assets. That's mostly land and houses in the process of being constructed. And also 750 million in net cash. That all compares to a 5.7 billion market cap. So it's trading below tangible book value, and it pays a 4.4% yield based upon a 50% payout of earnings. Next slide, please, John. So, as you'll have gathered from the title to the presentation, although I think Barratt is worthy of your attention, I don't think that you will end up buying the stock. And therefore, I have a two-part presentation focused on the two parts of that argument. First of all, why you should, or if you like, it's not what you don't know that will stop you buying. The fact that it's the best operator in the industry, that it has good returns of capital on capital. The shares are basically at a 10-year low, 54% below the all-time high, and it's trading at 47%, less than half my estimate of liquidation value. And then in part two, I'll talk a little bit about why you won't buy. It's what you know for sure that just ain't so. And that's a bit more of a macro argument, and we'll get to that in a moment. Next slide, please, John. So the reasons that you should consider buying. First of all, it's the best operator in the industry. It's the largest, so it has some scale advantages. It has also probably most of all the players, most invested in the off-site factory production of everything you can build away from the site itself. So things like kitchen and bathroom pods, timber frames, which are not which historically has not been the norm in the UK, and things like roof cassettes. All of these things it tries to build as much as it can in factories away from the main building site, transport them to the site, and then just drop them into the plot, which of course is a more efficient way of construction and lowers operating costs. I've already mentioned that it operates with three brands and price points, and compared to some other house builders, this gives it a wider customer appeal. It gives you a faster sales rate, and therefore you spend less time on the site. And it means that some large development sites are viable for Barratt that are not viable for smaller players. It has a pretty conservative cost-conscious focus and culture. It's run by the chief executive was the former CFO and is an accountant. And he's kind of created a culture with a focus on things like cost and efficiency and return on investment. And then importantly, land buying at Barratt is signed off at the centre, either by the CEO or the CFO. Some other house builders in the UK allow the regional divisions to sign off on land purchases, and that they typically have volume and growth targets, and that can cause some problems with overpaying for land. Second reason is return on capital. This is not specific to Barratt. This is taken from a Competition and Markets Authority study into UK house building last year, showing that for the 12 largest house builders in the UK, this is the pattern of return on capital employed. As you can see, other than during the financial crisis, returns have typically been slightly north of 20%. Just the two measures of return on capital shown on this chart, that's with and without the effect of intangibles. Next slide, please, John. This is my my estimate of Barratt's typical return on capital, which I think is, as you sort of expect, is fractionally better than the industry average, I believe. I won't go into all of the details here, but essentially you've got the basic cost and margin structure in the table to the left, showing that the EBIT margin is typically 19%. And then you've got the kind of capital employed calculation on the right-hand side, showing that at a margin of 19%, you get an EBIT of 22%. I'll leave it to you to work through those numbers as you see fit. Next slide, please, John. Here's a chart of the share price over the last 10 years. As you can see, it's reasonably volatile, as is often the case with cyclicals and UK house builders. It's more or less at a 10-year low, lower than it was even in the peak of the COVID lockdowns. It was at nearly £9 just before COVID, and it's currently more than 50% down from that high. Next slide, please, John. And then perhaps most importantly in this section is the price compared to my estimate of liquidation